Good morning, ladies and gentlemen. My name is Shabano Asad, and I will be your host for today. I welcome you all to this webinar on the launch of Karandaaz Pakistan's report on NBFCs in Pakistan, discussing the segment's regulatory landscape and bottlenecks. Before we begin this webinar, I'd like to request you all to please mute your mics and kindly add your institution's name next to your name. Today's webinar has been organized by Karandaaz Pakistan. Karandaaz Pakistan is a not-for-profit company funded by the UK's Foreign Commonwealth and Development Office and the Bill and Melinda Gates Foundation. The hashtag for today's webinar is NBFCs Pakistan. We will begin with opening remarks by Mr. Waqasul Hassan, CEO Karandaaz Pakistan, and welcome remarks by Dr. Shamshad Akhtar, Chairperson Karandaaz Pakistan, followed by a keynote address by Mr. Amir Khan, Chairman, Securities and Exchange Commission of Pakistan. Mr. Ali Khizr will then present a presentation on the key findings of the report, followed by a short Q&A session. We will then have Ms. Meher Shah, Director of Knowledge Management and Communications team at Karandaaz Pakistan, moderate discussions between our esteemed panel members. Lastly, we will conclude the session with closing remarks by Mr. Salim Raza, Member Board of Directors, Karandaaz Pakistan. Without any further ado, I'd like to welcome Mr. Waqasul Hassan, CEO Karandaaz Pakistan. Mr. Hassan has a rich experience in designing and implementing a wide range of development finance programs on infrastructure finance, public-private partnerships, climate finance, MSME finance, credit guarantees, and digital finance. He has also served as an advisor on financial sector projects in Afghanistan, Ukraine, Bangladesh, Jordan, and the UK. Mr. Hassan has a special interest in investment climate-related regulatory reforms, seeding innovation, entrepreneurship, and establishing key institutions that impact the financial landscape in the country. Over to you, Mr. Hassan.
Thank you very much, Shabano, for a very detailed introduction. Assalamu alaikum, everybody. Chairman SCCP, Amir Khan Saab, Dr. Shamshad, Chairperson, Karandaaz board members, speakers, panelists, ladies and gentlemen, assalamu alaikum again, and good morning. We are trying to touch on a very, very important topic today, the non-bank finance companies. I'll just give you a bit of a background that when I started working on SME finance or development finance in Pakistan, one of the issues that I saw was that if you look at Pakistani market and compare it with the developing markets, even just across the border, India, we would see that the non-bank finance companies are playing a very important role when it comes to product development, when it comes to reaching out to the segments which are not being served. I would like to quote here that there are specialized non-bank finance companies such as Mahindra Finance for medical equipment. You would find for solar energy, you would find specialized non-bank finance companies. But when we look at Pakistan, the landscape is not developed, is not sophisticated at all. In terms of sophistication too, not just the reaching out to the unserved segments, but in terms of in terms of sophisticated structures too, you could see that lots of securitization and on capital raising, very innovative structures are being used around the world, but none of that is happening in Pakistan. So I think as professionals who are on this forum, I think most of the people are leading in their respective areas. So it's something which should be of a mutual concern for all of us. So let's see how can we tackle and address this. So my main message, and which I truly believe in this, is that Pakistan's NBFC sector has the potential to contribute significantly to the financial inclusion needs of our enterprises, especially MSMEs. So we need to see what we can do so that the state does not look the same in years to come. This detailed report has been prepared by Ali Khizr, and it looks at broadly 4 things. First, what's the regulatory landscape? Second, what's the track record of lending NBFCs over the last decade? Third, what are the challenges that NBFCs are facing? And fourth, what is the potential for growth and offtake by this segment by leveraging technology to introduce tailored products? Panelists in the later sessions would be talking about all of these areas in much more detail. Just a bit of, I think most of us know about Karandaaz, but I will just try to introduce the philosophy that we use at Karandaaz. So the main thing that we do is additionality. Now, it can be in the technical investments, it can be in the actual investments that we make in the market, and it can be in the knowledge space as well. By additionality, what we mean is that we try to add to the existing knowledge in the country in specific areas. In areas where the knowledge is either outdated or requires some sort of intervention or nudge to move the needle. So additionality is the main thing for us in all the instruments that we use. In the knowledge domain, we have mainly, I would say, two roles. One is of a knowledge creator, and the other is of a knowledge intermediary or knowledge disseminator. And it's just not limited only to non-bank finance companies, but we're using this approach in other areas too. For example, in green finance, we have developed a, we have worked on a comprehensive report, and soon we'll be launching that too as well. So in all those areas which relate to development finance, but the knowledge is either lacking or needs to be updated, we try to work on that. We have worked with SECP on some of those areas. We've also worked with the State Bank of Pakistan on digital banking regulations. So all of these are examples of how we are using knowledge to move the needle in Pakistan on development finance. As a knowledge creator, Karandaaz has conducted research on several niche sectors. Publication by Karandaaz focused on Pakistan's transport industry, the medical diagnostic space, the small builder financing, to name a few. The outcomes of these research studies have been informed several interventions by Karandaaz itself too, and these reports have been made available for the wider market too, for commercial banks or non-bank finance companies if they want to take those forward. As knowledge disseminator, we have set up this portal, and we make all our reports available on the website, and we also engage and hold such dialogue such as this one to discuss the issues in detail. Karandaaz, when it comes to non-bank finance companies, is not just working on the knowledge area. We have also worked with the SECP on you can say on infrastructure, on information technology infrastructure, which can strengthen the overall landscape or the overall environment in which the non-bank finance companies are working. And then we have performed a very important role of seeding such non-bank finance companies which did not exist in the country. I'll just give you examples. Pakistan Microfinance Investment Company is the apex wholesale microfinance lender to the sector. Such a wholesale lender, market-based wholesale lender, did not exist before. We had PPF, but that was more state-funded, and it was not integrated with the market. Similarly, last year, we set up Infrazamin Pakistan, which is, would be doing guarantees for infrastructure credit enhancement. This year, we have launched Karandaaz Financial Services, which would be doing innovative financial products for the SME. And we have also about to enter into a partnership with the Ministry of Finance for a credit guarantee company for the SME finance. So we are putting our we are putting where our dollar, where our advice of mouth is too as well. So I now just talk about two high-level statistics. So the SME policy is out. We have it puts the number of SMEs at 5.2 million. Of these 5.2 million, only 200,000 SMEs are being catered by the formal financial sector. So clearly the needle needs to move. Now, NBFCs obviously will have an important role to play in this. With this now, I would pass on to Shabano, back to Shabano for the next sessions. But before that, I would like to thank Chairman SCCP, Mr. Amir Khan, for his support in all of these areas, to my own chair, Dr. Shamshad, with whom we always have very engaging discussions, and she keeps on pushing and nudging us for even more innovative work. Salim Raza Saab, who is the director and chair of the investment committee, and I would say a critic of the commercial banks in some of these areas too. Ali Khizr, thank you very much for great work. You are a leading economist. And thank you to my own team, Meher Shah and Ali Akbar, who have worked very closely with Ali Khizr on several of these drafts. Over to you, Shabana. Thank you.
Thank you, sir, for sharing your insightful thoughts with us. I would now like to welcome Dr. Shamshad Akhtar, Chairperson, Karandaaz Pakistan. Dr. Akhtar has a broad-based development career in national and multilateral organizations spanning over 37 years. She has also served as the Governor of the State Bank of Pakistan, Under Secretary General of UN SCAP, Senior Special Advisor on Economics and Finance, and Assistant Secretary General UN. Dr. Akhtar has also served as the Federal Finance Minister in the caretaker government prior to the general elections of 2018. Dr. Akhtar, ladies and gentlemen.
डॉक्टर साहिबा म्यूट पे हैं आप.
Am I audible now? Hello.
Yes, ma'am.
अच्छा, ठीक है. So, Assalamu alaikum to everybody, and first of all, let me thank the SECP chairperson for gracing the occasion of this knowledge product that has been pulled together by our team at Karandaaz. I think the chair of SECP has been an ardent supporter of Karandaaz. We have worked together on different platforms, and I very much appreciate his presence. At the same time, let me also thank Ali, whose articles now go beyond business recorder to writing reports for Karandaaz. So thank you, Ali, for supporting us. I think a lot has been said by our CEO, Waqas, who's very passionate and has been very instrumental in laying foundation for Karandaaz. I have to say, to its credit, Karandaaz, in a short span of its operation, has achieved quite a few milestones, ranging from the establishment of a diverse set of private ventures to supporting financial intermediation with or without equity or other instruments for underserved people and sectors, to offering of now innovative instruments, innovative institutions to leverage additional finance from the markets for development for business. In the process of establishing a range of companies and structuring transactions, Karandaaz has accumulated experience and knowledge of Pakistan's financial sector, but also has really taken us through the journey of others in how we have structured our interventions. Karandaaz accumulated experience and knowledge of financial sector of Pakistan has offered innumerable lessons learned and reflections on how we can do business and deliver the needed finance in a country with high level of financial exclusion and high level of political noise, weak institutional, legal and regulatory base for non-bank sector. In this context, I think Karandaaz's study on Pakistan's regulatory landscape and bottlenecks is indeed a valuable contribution to guide our industry on way forward. Our economy has for long been underserved by the financial sector, which is really the banking sector, as evident from high level of financial exclusion that has been documented by Karandaaz a lot. The World Bank evidence is quite telling. Domestic credit to the private sector by banks as a percentage of GDP in Pakistan was barely 17% in 2020, well below the average of South Asia at 59%, and for middle income countries at 119%. Second, only about 8% of firms use banks to finance their investments, again, well below average for South Asia at 21.9%, and for middle income countries at 26.4%. The ADB's Asia SME Monitor 2021 suggests that MSME financing as a proportion of total credit is below 6% in Pakistan. It's well below loans offered by banks and financial institutions in Nepal at 16%, India at 17.6%, and in Bangladesh at 20.2%. So unfortunately, we have a long journey and a complex task at hand. In Pakistan, given that a large proportion of our economy falls in informal space, almost estimated at 56% of total GDP in 2019, and accounting for almost 72% of employment in jobs outside agriculture in the country. There remain real challenges such as non-performing loans, risk averseness of the lenders, in particular the banks, and skewed commercial lending that favors particularly the public sector, given the risk-free return supposedly that the government offers on its treasury bills. As a result, the number of SME borrowers serviced by banks has barely been 200,000 from 2011 to 2022. You may be shocked to hear that we are today at the same point where we were perhaps in terms of the numbers when I left as governor, but as a proportion of credit outstanding, we were higher for the SME sector than what we are today. So there has been a regression rather than a progression. Success of emerging markets has depended critically on how we facilitate our SME sector, both in terms of finance, but back it with conducive policy, legal, regulatory, and technical support. The lack of access to credit cannot be examined in isolation, but it requires looking at the entire ecosystem of Pakistan. The unnatural edge being given to the banks relative to non-banks is literally unacceptable. Our credit markets and its players are too focused on their own corporate gains rather than extending the development dividends to the stakeholders, i.e. the debtors and the retail borrower, and making sure eventually that we pass on the financial edge to our retail clients. Globally, there has been a deep dive in SME finance. And we are, as Karandaaz, party to a lot of these international Asian and non-Asian financial forums. SME finance deep dive is critically needed based on rude awakening that though bank lending has been tasked to meet SME credit demand, both quantitatively as well as in other ways, given their deposit licensing edge and liquidity enhancement powers, and their edge on the scale of through the branch network, to me, it's a surprise that none of that has worked to reach the retailers. It is now to reach the clients, SME clients. It is now well acknowledged that nurturing non-bank SMEs or non-bank service leveraging platforms, they could be non-profit companies, is critical, as banks either don't know or don't want to risk cash flow financing modality and seek from SMEs pledgeable assets which they don't have. You may not believe that the cash flow financing modality and training was offered when I was at the central bank. So fast forward, we are still where we were. Newer, innovative, and fast-growing SME companies have indeed a higher risk return profile, but countries have been able to develop dedicated credit information bureaus. And we had on Karandaaz platform, people from Japan, both the academics and practitioners, who explained how they are doing it. Ultimately, you do need credit enhancement to mitigate risks. And hence, Waqas mentioned about the SME credit enhancement institutional framework, which we are promoting at Karandaaz. He also mentioned about a Karandaaz study with a number of SMEs that are estimated to 4.5 million. The total size of SME credit market, according to that, is computed to be about 4 trillion Pak rupees, which is several multiples of the current value of outstanding loans to SMEs at Pak rupees 524 billion. Now, successive governments have placed major emphasis on SME financing, committing in 2019 to quadruple the number of SME borrowers while increasing the share of SME financing in total private sector loans to 17% from the current levels of 6.5%. If growth in SME lending is the objective, conventional banks alone cannot do this job. Non-bank financial companies will need to be at the center of that strategy. SME lending requires a more focused and customized approach, something that SMEs have a competitive advantage in, provided they can enhance the breadth and depth of their product offering and systematically leverage the technology ecosystem, given that digitization is playing its role in this area. So we have a long way to go. We also know the best practice regulatory framework. So while it's true that lending NBFCs in Pakistan currently accounts for total outstanding credit of barely 62.5 billion relative to the trillions I talked about, if we assume 50% of this goes to SMEs, NBFCs account for less than 5% of total credit dispersed to SMEs. But that alone should not and cannot provide sufficient justification for overlooking their potential role in reaching unbanked and underbanked sectors. I mean, I can go on about this sector, but in interest of time and allowing others to speak, and I'm sure people will deliberate a number of facts and figures which are quite instrumental in telling us where we stand. The number of lending NBFCs actually has not risen, but has dwindled significantly since the financial crisis of 2007 and 8. So of the 70 odd lending NBFCs, there are Mudarabas and there are non-bank finance, microfinance companies. We also are fortunate to now have new licensees. Pakistan Microfinance Investment Company, which has been promoted by Karandaaz, Infrazamin, again promoted as a credit enhanced entity, and Taleen Finance Company, so on and so forth. What we are also proud of is that SECP has established a regulatory sandbox, and I'll let him dwell on that. And it is important now that after this knowledge sharing, that we come up with a game plan on how do we move forward to fast track the implementation, more so on the SME policy side, because that's where the weaknesses are, in addition to the lack of capacities that exist. So in summary, NBFC, through innovative products and nimble onboarding, credit evaluation, disbursement, monitoring processes, can capitalize on a largely untapped market, which requires at this point access to capital, but knowing how to go about developing your clients. Within the region and elsewhere, we have seen NBFCs playing a critical role. They promote sustainable development, offer climate support, and offer core infrastructure and all other sectoral support. I think if NBFCs were to position themselves effectively through the support of SECP, I'm positive that we will be able to whip the NBFCs to deliver and leverage more development. In the end, once again, let me reiterate my special thanks to Chairperson of SECP, and also would like to thank Karandaaz sponsors, both the UK's Foreign Commonwealth and Development Office and Bill Melinda Gates, which has been playing an instrumental role on the digital frontier for the banks, and hopefully we can extend them to the non-bank financial companies. Their continued support has brought us where we are, but will take us bigger heights as we move forward. Thank you so much for being here, and thanks once again to Ali for being courageous enough to pull together this report. Over to you all.
Thank you so much, Dr. Akhtar, for sharing your invaluable thoughts. I would now like to welcome Mr. Amir Khan, Chairman of the Securities and Exchange Commission of Pakistan. Mr. Amir has 30 years of experience in banking and capital markets, covering corporate, investment, SME, and institutional banking in Pakistan and Canada. He has worked with various national and international banks, including Royal Bank of Canada, Standard Chartered Bank, and American Express Bank. Please welcome Mr. Amir.
Thank you. Bismillah ar-Rahman ar-Rahim. Your Excellency Chairperson Karandaaz, Dr. Shamshad Akhtar, Honorable CEO Karandaaz Waqasul Hassan Sahib, Dr. Salim Raza Sahib, Ali Khazar Sahib, ladies and gentlemen, Assalamu alaikum. First and foremost, I think I would like to acknowledge the hard work that went into preparing this report. And in that regard, I think Mr. Ali Khazar deserves a special mention for the great work that he's done. The report captures key areas concerning NBFC domain and makes cogent recommendations to improve the role of NBFC sector in the overall lending space, more specifically for the SME segment. When we look at the recent data, the outstanding financing by banks to SMEs has increased from 482 billion in 2020 to 524 billion in 2021. And this reflects a growth of 8.8% in a single year. However, when we look at the number of SME borrowers during the same period, they have recorded a decline of 8.4%. Currently, as mentioned by Waqas Saab and also the chairperson of Karandaaz board, the SME financing accounts for only 6.5% of total domestic private sector financing. This is a staggeringly low ratio, considering that SMEs account for over 90% of businesses and contribute approximately 30% to the GDP. Perhaps the most significant concern for NBFC's commercial viability stems from their high cost structure, which is brought about by, firstly, a limited capacity for resource mobilization and their extensive reliance on credit lines, mostly short-term, from banks. Secondly, is their inability thus far to leverage an increasingly digitalized financial and telco ecosystem that exists today. Finally, an exclusion from the government and central bank-backed concessionary funding has also been a cause of concern, as highlighted by Dr. Shamshad earlier on. These factors have constricted the growth of NBFCs in Pakistan and have been a contributing factor in our inability to match some of the ambitious targets that were set in the National Financial Inclusion Strategy. It is actually somewhat frustrating that despite significant developments in the regulatory framework, the digital infrastructure and market demand, SME lending has struggled to take off in a significant manner. Improving access to finance has remained one of SECP's core objectives. And as acknowledged in the report, recent regulatory reforms have provided the NBFC segment more room to innovate and leverage technology-enabled business models to their advantage. I think it would be fair and in fitness that if I briefly touch upon some of the recent initiatives that have been taken by SECP to foster sustainable growth of the NBFCs. Firstly, to promote a sustainable operating model, ease of doing business, and to create healthy competition, SECP has simplified and modernized NBFC related regulatory requirements by firstly encouraging startups and innovative tech-enabled platforms to register and operate under NBFC's regulatory domain. Another one is the introduction of the concept of qualified capital. Likewise, encouraging long-term sustainability of NBFCs through requirements for improved governance, credit underwriting, and liquidity and risk management. is also a main step. Additionally, improving operational efficiency of the corporate restructuring companies in acquiring and resolving non-performance assets has also been handled both at the legislative as well as practical level. Finally, there has been a dedicated NBFC law that has been introduced, and it is quite a landmark change in regime from where we are at this point in time. However, it awaits placement before the Parliament. Secondly, I would like to highlight measures taken to address the liquidity challenges of NBFCs. As you are aware, SECP has always encouraged the NBFCs to tap the capital markets as a source of long-term liquidity instead of singularly focusing on bank credit lines. In this regard, recent progress includes relaxing requirements for listing of privately placed debt securities, reducing CDC's tariff structure for debt market securities, redefining eligibility criteria to expand the distribution of redeemable capital, facilitating the creation of the first ever microfinance sector specific social impact fund, which will invest in debt instruments to be issued by NBFCs, and finally helping NBFCs transformation from not-for-profit to for-profit structure to improve their operational efficiency and their ability to raise financing for private capital. Thirdly, SECP has also been able to garner the support of the Ministry of Finance and the State Bank of Pakistan for inclusion of NBFCs and housing finance companies as executing agents in Karandaaz Pakistan program. Two NBFCs, namely NRSP and Akhuwat Islamic Microfinance, have so far disbursed over 5 billion rupees to approximately 28,000 borrowers under this program. Fourthly, to encourage innovative business solutions, the Regulatory Sandbox Initiative has paved the way for startup and technology-enabled companies to bring forth their ideas that are not covered by the existing regulatory framework and test those ideas in a controlled environment with active support and help and guidance from the regulator. Under the first two cohorts held so far, a number of innovative ideas relevant to the NBFC space have been approved for testing, including P2P lending, digital distribution, and robo-advisory. And this program has directly resulted in bringing further reforms to the regulatory space through introduction of new concepts. These reforms have yielded many positive outcomes. Over the last 3 years, SECP has licensed 18 new lending NBFCs, including 4 housing financing companies. Now, previously, there was not a single licensed housing finance company, and all of these licenses have been issued in the last 18 months. NBFC operations of buy now, pay later, P2P lending platform, and digital nano lending have also been approved by the SECP. These technology-enabled NBFCs have collectively reached out to over 365,000 new borrowers with cumulative disbursements of 6 billion so far, which is a very small amount if we look at the rupee figure, but in terms of the new borrowers that have been targeted is quite encouraging. Likewise, the first ever corporate restructuring company has been licensed and approval has been granted for incorporation of 2 more CRCs. In a first, an NBFC has been licensed with the core business of issuing guarantees against financing to infrastructure projects. Through proactive support and help extended to the Ministry of Finance and Karandaaz Pakistan, SECP has granted permission for the formation of the National Credit Guarantee Company Limited as an NBFC. SECP has also licensed an NBFC with core business of providing direct finance to SMEs, an initiative that is being very valuably conceptualized by Karandaaz. Furthermore, the first NBFC focused on agri-lending, supply of pre and post-harvest ingredients and information sharing with farmers is in the process of being granted a license. Finally, while there has been progress, and this progress notwithstanding, I would like to share some thoughts on areas where I believe the NBFCs must focus to become significant financial sector players. Foremostly, I think NBFCs should not try to emulate as banks because they do not have the wherewithal or the advantages that are there. They should instead focus their efforts on developing a deeper understanding of different customer segments, such as the MSMEs that are not served or radically are underserved by traditional financial institutions. Secondly, NBFCs need to embrace digitalization and move away from an exclusively brick and mortar approach. The use of data science has revolutionized the financial industry as analytical tools and modeling algorithms provide the opportunity to service providers to gain valuable insights into market dynamics, customer needs, competition, and risks. The use of data science is one of the areas NBFCs need to focus on, as given their structure, they have the flexibility to both take calculated risks as well as to venture into areas that are not catered by banks, such as the MSME lending space. Thirdly, there is an urgent need for sound liquidity management. As I touched upon earlier, to achieve ambitious growth targets in the long run, the sector must explore alternate means of raising long-term financing through capital markets. They should also focus on alternate lending approaches, such as the use of P2P platforms. While they may require adjustments and investments in the short term to make these changes, over the long term, such an approach will prove immensely beneficial for building both scalable as well as sustainable business models. Fourthly, NBFCs should focus on co-branding and collaboration with established operators in other industries, such as banking, insurance, real estate, developers, cellular companies, etc., to use their services and outreach for offering value-added solutions. Also, the NBFCs must up-tier their product suites to create customer-focused products, such as leasing of machinery for SMEs, agri and livestock sectors, agri-produce warehousing, rental of agricultural machinery, distribution of crop insurance, supply of fertilizers and quality seeds and providing pre-harvest financing in those areas, and finally providing crop and weather information to farmers and many other areas. There is also immense potential in the space of consumer financing, as most of the population does not have access to formal credit, but they do have real financial needs. Finally, I would like to say a few words about the governance standards that are paramount if NBFCs have to establish themselves as viable and strategic part of the financial services ecosystem. NBFCs need to develop an understanding of their target market, the broader risk implications, and develop appropriate risk mitigation strategies on scientific basis to account for changing market dynamics and to continue to evaluate their business models backed by solid research. In conclusion, I would like to acknowledge the role played by Karandaaz and thank them for their commitment to promoting financial inclusion, in particular, enhancing access to finance for SMEs. And as always, we at the SCCP look forward to valuable ideas and suggestions as we strive to modernize and develop the NBFC sector in Pakistan in close collaboration with all stakeholders. Thank you very much.
Thank you, Mr. Amir. I'd now like to welcome Mr. Ali Khazraslam to share key findings from the report. Mr. Ali is a senior columnist with over 15 years of experience in economic, financial, and business research analysis and communications. He established the Economic and Business Research Department at Business Recorder, the country's leading financial news daily. Ali also engages with leading organizations in the development sector, with multinational entities in the corporate sector, and in the capacity of an independent consultant and advisor. Over to you, Mr. Ali Khazr.
Thank you, Shebano. Thank you, Chairman SCCP, Madam Shamshad, Waqas, CEO Karandaaz, and team for joining this and taking time out to read the report. And I'd like to give special thanks and attribution to the team who worked relentlessly on this report. Huma Sattar worked with me, then Meher and Ali Akbar, who worked very closely on this report, and they pushed us on the various drafts to improve it and the version which you have right now. So I would not take much time and would like to go through a bit of PowerPoint. And so Shabanu, shall I share the screen, or you have you're accessing?
You can share the screen.
Okay. Just a second. Can everyone see this? Yeah. So when we talk about the NBFCs, I mean, it used to be under the domain of the State Bank back in days, but in 2003, SECP decided to take this, and we'll go through the journey how this had happened. But when SECP took the NBFC sector into its regulation, it was weak, and then the NBFCs were not really geared up to the lending. But there was a time before when it was in the State Bank, and they were focused on the SME lending. So before 2008, the SME lending peaked at in terms of GDP and in terms of private credit as well. But thereafter, 2008 crisis, there were downturn into it, and we'll go through in the detail. But based on that, SECP stayed as prudent regulation and made some changes, but they weren't enough. They weren't enough to lure the NBFCs into lending sector. Then the changes and amendments in 2015 were progressive, and based on that, there was some improvement. And lately, under the Amir Saab, there's some more changes into that. And now we expect the NBFCs to spur in Pakistan, like the way Waqas said that they have penetrated very deeply in India. Right now, NBFCs are basically into two sectors, one the asset management NBFCs and one the other lending NBFC. So we're not talking about the asset management, it's altogether a different class. Within lending NBFC, there are two types of that, which are deposit taking and non-deposit taking. And they're within the deposit take, within the lending NBFCs, there are different licenses, but the most important license is investment finance services, under which you can do the leasing, housing services, and discount services as well. So that is something the SHGP has done over the period of time. It's a matter of time for companies to take into that. I mean, in terms of regulation, if we see this, the NBFCs have lesser stringent requirement in terms of capital adequacy ratio, cash reserve ratio, minimum capital requirement, and there are no caps on deposit, and then a statutory liquidity requirement are none for them. So because of the stringent restriction and lesser oversight from the regulator, like the way State Bank regulates the commercial bank, SECP doesn't really look into that stringently into this NBFC. They have a room to innovate, and they have a room to serve unbankable segment. And there where there's the gap is and where the push is. And where the SECP, Karandaaz, and we are all trying to say that there's a gap of huge, like we said that whatever the lens we take, 4 to 5 million MSMEs in Pakistan, and out of that maybe around 200,000 have access to lending. And what I did a study back for Karandaaz a few years back, in which we realized that there are many borrowers which are dead borrowers, and they are being carried off of that. Like from NIB time when they came up with their model, Salam banking, so they were borrowers still present in the debt. Then you have SME defunct lending borrowers, they're still over there, SME bank. Then you have at the point Bank of Punjab was giving 50,000 loans to those pickup cars and all that. These were included in that. That's why when you say that there's a decline in borrowers despite increase in the loaning, is because those dead borrowers are slowly getting out of the numbers. So, but we need to realize that the actual borrowers, the borrowers of SMEs are even less than 200,000, and they're much less. And now the question is, who should regulate SME and NBFCs? Now that's a very fundamental question, because they're not have any access to lender of last resort. They don't have any access to the refinance schemes and the other kind of support and push from the state bank like the commercial banks have, so they are at a disadvantage. So it remained a disadvantage, but the lately SECP is really moving fast, but that's remain a case in that. So there is no point of having non-lending NBFCs under state bank. There should be SECP rule. And lending with the state bank, but in 2002-3, the state bank was focusing too much on the banks. There were too many NBFCs with a too smaller size. So State Bank thought that their resources are too much occupied on that. And then when the Khalid Mirza came in SECP, he wanted to have some kind of a financial oversight council or some kind of a board where SECP to lead the role. So they took this NBFC into the SECP, but it took about 18, 20 years to move that transition. And I hope that with under the Amir Saab and going forward, that role what Khalid Mirza thought at that point of time would fulfill now. So, I mean, so if we see that, do we need to have SPP regulating as NBFC? I don't think so. That's the case, but they could have an access to somehow the refinancing scheme, like directly or indirectly through wholesale lending. They should have some side of comfort of lender of last resort or some side of guarantee scheme from the government and all that. So which state bank and government is offering to the banks, they should be to the non-banks as well. So that's a very important point over there. I mean, as I mentioned that over time, SECP has been deepening its understanding of lending NBFC. So it's heartening to see that this is happening. The prudent regulation are being changed and they're being improved. In 2015, they've removed them. They've reduced the maximum exposure to reduce the risk. Then there's a concept of small and mid-size non-deposit taking NBFC was introduced. So NBFCs can come up with a smaller paid-up capital. Like I mentioned that the paid-up capital was higher back in 2008 or something. And when the crisis came, the paid-up capital was further increased. And that was like nobody wanted to be in the business. Are you going to the bank business, which is serious financial business, where you put money, you have deposit taking, you have payment access, and you work on the model for NBFCs, where they're more vulnerable to external shocks and everything, and then you're increasing the paid-up capital and the other requirements while they're facing the losses. So the model was really failing, and mostly the NBFCs have failed in that. Very few. One option is Oryx leasing, which actually survived. The rest of all them failed. But now the things have changed. So they've introduced a concept where the concept of capital adequacy ratio is reduced. And then you have the other requirements which are less stringent, and SECP is more pushing and helping a non-banking financial institution in the lending space. So I hope the way the few new NBFCs are being formed in the next few years, they'll really spur the way they did in India and other economies. I mean, as this is the most important slide in terms of the history, as Madam Shamshad showed as well. If you see this. The total credit to private sector. I mean, it used to be it peaked at 27% in 2008 when Madam Shamshad joined as a governor of State Bank, and then the financial crisis and everything. Then the fiscal deficit started growing as well, and the reliance on the domestic banking sources increases. So the private credit to GDP ratio started falling, and it fell from 27 and hovering around 17% right now. So there's a secular decline if you see this, and that's one of the reason is the borrowing is relying from this government borrowing relying on the commercial banks, and now strictly there's no SPP lending allowed to banks, to government. So the reliance is increasing every day. And then the most shocking thing is that within the private sector borrowing. Within the private sector borrowing, which is falling, SME borrowing as a percentage of private sector is falling as well. So it's a double whammy for SMEs. And in terms of GDP, they've shrunk from something like 4% to 1% now. I mean, it's shamelessly low number. It's a shamelessly low number for all of us. It's just got down to 1% of GDP. And of course, the reliance is on the commercial banks, and the commercial banks' focus has largely moved away from the private sector, and within the private sector, they saw that SMEs are a riskier customer, and it takes too much time for the banking to gauge the credit risk and everything and all that, and so they don't find it like commercial worthy to lend. So that's a problem. And we see that the total number of SME borrowed declined from P for 215,000 to 113. Now that's a number you have to see that the number is falling, and I told you about that. There's some dead borrowers into that, and if you take that out, I would assume that the borrowers are somewhere around 100,000. It would be even less. I mean, which are active borrowers, which you can really say that they're SME borrowers. I mean, why banks are disinclined towards lending to SME? Number one, SMEs do not have a formal cash flow management. They do not have like a formal accounts arrangement, and then they try to run a few books, for one for the taxpayer, one for themselves, and one for the lenders or something. So there's an information asymmetry. For banks, they don't have access to information which they require to assess the risk. And to access that information, they have to work hard. They have to get into the books. They have to understand the model. For that requires time. But the loan size is small, the return is small. So the relationship management model, which is the basic model of the banks, they don't find it cost benefit to do that kind of a cost because the returns are low. And they rather rely on the mid-size corporate, commercial, and corporate, where it's easier to assess the risk, and mainly it's name lending. We all know that, and then the returns are high because the loan size is big. Then there is another problem of collateral. I mean, SMEs are hard to find the collateral, clean collateral. And if they have, then they are reluctant to go to the bank because in the downturn, if the SME goes south, they have their the real estate immovable collateral at risk as well. So those are the things. Then the history of high NPLs, it went up to 20%, 30% in 2012, and it came down up now. But still, there was a high NPLs, and that's the banks are not really keen into that. And even if the decentralized model was adopted by NIB Salam Banking, that failed as well. So banks are not really inclined towards lending to the SMEs for these reasons. Now, SME lending, so this is one thing is the banks. So if you see the landscape and if you see the graph, there were SME lending was mainly into by the leasing companies. The NBFCs, lending NBFCs were leasing companies. But if you see the graph, the leasing company size have declined. It's because there was a one good leasing company that's operating, Oryx Leasing, but has changed the license of IFS. So that's going over there. The rest of all the leasing companies have died down or they're dying. Then the Mudarbas were going. They're growing at a good pace. But the problem with the Mudarba is they didn't really work for the lending purposes. There are other purposes of advantages of Mudarba in taxation and parking and everything for a group. So they form Mudarba to park their own investment for tax advantages and all that. So the essence of Mudarba is not about the SME lending, like what the RSA leasing and is doing. So the Mudarba growth is you cannot see really it working on that. Then you have investment banks, of course, they are not into the lending and NBFC side. And then the real growth you see is the micro-based. So the micro financing has grown up really, right? And they have a big numbers, but they are covering a smaller size, which is under 600,000 loans or something like that. So they're not covering, they're just covering M, and the S and M is mid is missing, especially the missing S. That's a big problem. Yeah. So yes, the NBFC lending segment is overlooked, and we need to work on enhancing on that. So there are some things which are required to be done and should be done. One is that they should have access to refinancing. They should have access to credit guarantee. So the banks, all the credit guarantee, whatever being offered, and even if the offer in the recent SAF lending program of the State Bank, it's to commercial banks. Now GOP is in the process of establishing credit company with NBFC will have access to it. So that's solved the problem of collateral, and that could reduce the risk of the NBFC, and that could reduce the cost of their borrowing as well. So one of the reason banks have a bigger share is that banks' of cost of funds is inherently low. They have access to deposit, and within Pakistan, 30% order current account, then 30% order saving accounts, then 30% order fixed account, time deposits. So bank cost is much lower and then NBFCs have to work on borrowing from the banks and the area, which was usually K plus. So when they are borrowing at K plus 1 or 2, so they have to have a K plus 8, 10 to get that. So they're to the risky business. And because they're going to the risky business, their borrowing cost is getting high. So once they have access to credit guarantees, so their borrowing cost would reduce that. And of course, they'll be able to lend more to the SMEs and take risk and can make some products which are required to move away from the relationship model. Then the multiple refinancing scheme, as I mentioned earlier, State Bank has. These are to be, they should have access. SMEs should have access to it as well. And then the STR, of course. There's a problem that the collateral was only available as immovable collateral, and movable collateral, it's lien. There was a confusion on that. Now digitization of the secure transaction registry and everything. And again, Karandaaz has done a good work, and SCCP has done good work into that. So NBFCs have access to this STR, and they'll be able to enhance the collateral portfolio there. So then the next thing is widespread uptake of digital finance beyond payment and truly digitizing the economy. If that started happening, the data aggregator would start happening, and data would be gathered. That could really help in boarding SMEs for NBFCs. Now, this is the SMEs Asan scheme. This is the new scheme which State Bank has offered last year. I mean, it's a great scheme, but again, there's no access to NBFCs in this. So the target audience is SME, mainly S. The loan size is less than 10 million, so that's really catering to the S segment. So that's one area, and then there'll be clean lending into it. So that would be the collateral-free lending into that. So that essentially new players can come into this. So, and in the SAF, the rates are lower as well. The banks, SPP would be providing refinancing at 1%, and banks have 8% up to the risk and the cost to have digital infrastructure and everything for have SMEs to cover on that. So they have 8% spread for those two very reasons. And then there is a GOP partial guarantee scheme, which is like 60% cover for loan up to 4 million, 50% for 4 to 7 million, 40% for 7 to 10 million. So it's a no-brainer for banks to go into that, and many banks are going into this as well. And since it's refinancing, banks are not using their own liquidity or deposits. So this essentially this is generating new liquidity as well, and it's creating new deposit as well. But this is not available to NBFCs. Now, what SCCP is required to sit down with the State Bank, what Karandaaz is required to push on the State Bank, and we are required to push through our writings and all that, so that they should have some kind of an access to that. Like the way the Karandaaz Pakistan program, they came up with a model of wholesale lending from commercial bank to microfinance institutions. So they could have a wholesale lending, and many microfinance institutions are NBFCs. And so they can have a wholesale finance lending or somehow connected to the bank where they have access to Asan scheme or other. That would really help and kickstart the SME financing in NBFC domain. And you can see new NBFCs coming into that. Now, if you see their digital finance, I mean, I'm a big proponent of digital finance or digitizing the economy. And when I see the problems of Pakistan economy, whether you look at from the taxation purposes, whether you look from the purpose of the currency in circulation, which is very high, or whether you look from the perspective of that the lending, the formal lending is low, So all those problems can be solved digitally. And digital solution, onboarding, low cost, seamless, infrastructure spread, internet connectivity, learning by the consumer. So this can go a long way, and this could help really in NBFCs to spur in Pakistan for in the lending side. So one thing is regulators should move beyond banks. Regulators should move beyond banks. Regulators should move beyond banks. This is very important step. So I hope we have people from State Bank listening to this as well. So this is very important. And banks have several lending avenues. We all know that they have a low risk reward profile. Their funding cost is low. They lend to government, and then they lend to big corporate sector, and a little bit of consumer again in the auto loans. That's about it. Why would they go to NBFCs? So their motivation is not there. Now, with the digital disruption, fintech, there are some fintechs growing in aggregator. We have Hubble, then Kasif is here. They have doing in Finja, where they have a portal, then they have an EMI license, and they have an NBFC, and they're amalgamating all that and creating models. And one thing is supporting the other. The portal and the EMI license giving them the data. Their data is being used to lending in the NBFC domain. Then Hubble is an aggregator that's working on something. That data can be used by banks and non-banks to lend to the SME. So those PSO, PSP, EMI license are there. RAST is launched. Then as a chairman, SECB mentioned that this regulatory sandbox is there, and that's helping in the fintech. So fintech is the key in this. And that fintech can provide synergy to NBFCs. So the missing link in NBFCs is the data and linkages to reduce cost to assess better risk. And that can be leveraged to strategic partnership with the into digital space. And there's something very important. So I see NBFCs coming into the digital space by themselves, or they're partnering with aggregators and fintechs, and that can really move the way forward in Pakistan. So, and this is what there's an example of digital supply chain, and and that can create excess liquidity and reduce turnover time. So, if you see that the typical supply chain model of Pakistan, so you manufacture, you're a Unilever, and then you supply to the distributor. The distributor / supplier pays advances, and it takes 3-4 days to get the product. Then the distributor supplies at was to the retailer, and retailers, once it's they sell the product, then they provide the cash to the distributor, and that's all. The distributor is taking the risk in that. He's paying in advance to manufacturer, then waiting for the payment from the retailer, and then the distributors have to go to the bank, from one payment, or retailer one payment to the other payment. They have to make cross checks. They have to take the receipts from one place to the other. There's a huge cost in it. The rider is going on. There's a cost of banks, instruments cost, and then the funds takes time in the process to transfer one place to the bank's charges on the float and everything. So there's an estimated annual cost is about $375 million of this chain market size of $125 billion. So 125 from manufacturer / importer to distributor, then the distributor to retailer, then retailer to customer. So there's a 3 times 375 billion amount of that, things move on, and with the size of 125 billion, and the cost is $375 million is estimated that. And if you use the digital means, that can free up the liquidity of 800 million to $1.5 billion. And once you free up that liquidity, that can use and the data coming from that is used for the distributors, lending distributors, sub-distributors, and retailers. So that's a beautiful model, and we can work on that. And Pakistan probably is moving on that model. And here's one example on that, enabling supply chain financing. Again, it's a case of Hubble. it's a startup, started with funding from a state bank, and now it's growing. And that's what I talked about is they have this model. I mean, it's a technical thing, but they're connecting, they have the data, NBFC connect to their system, get access to data, process this, use the data from the credit rating agencies and all that. And then, based on those, you do the analytics and give loans. And that's how your cost would be reduced. So again, this is one very good example of again, Vikas talked about India, and my favorite example from India is the wholesale lending. This is a case of Northern Arc. I mean, it's a beautiful case. In Northern Arc, provide the wholesale lending to specialized NBFCs, and they also target the market where the informal credit is there, and they convert into formal credit. Now, Pakistan has a huge informal credit, and there are big markets in that. If you tap into that through wholesale lending model and make specialized NBFCs over there and provide them the product based on the informal lending, whether it's a bike borrowing, whether it's a furniture making, whether it's in supply chain of any other sector, you get there, you connect the dot. So that kind of a model, maybe Parvaz can work onto the model, and maybe other NBFCs can work into that model, and SECP should encourage such kind of a model to work on that. So it facilitates lending in the financially excluded segment. Again, we talk about informally, a sector over there. They're partnering with a key institution like microfinance companies and NBFCs. And then NBFCs can afford liquidity. Again, one of the problems we discussed about the NBFCs is their high borrowing cost. So by using this wholesale lending proper, the Northern Arc is using cost of fund. They're lowering through that structure finance product and market-based price discovery. And there's less reliance on bank borrowing for the NBFCs. And then they work on the strategic partner selection. So those help in that. Then the Northern Arc covers create that from the capital market. Again, Salim Raza would talk about it. He's very passionate about that. The Pakistan capital debt market is not there. SMEs, NBFCs don't have access to the commercial paper, debentures, and all that. So those kind of a market is required to there for reducing their cost of funds as well. And then the most important thing is the skin in the game. Northern Arc has a skin in the game. They take the risk with the NBFC. So when you take the risk, then you look into that. So I think if the Pravas looks into this, they have to look at the risk and all that. And I can see that Chief Risk Officer is there as Amir as well. So they should be thinking how to work on this model. So again, this is digital focus retail banking, how this could work. This is simple. I mean, there's a risk assessment department. Then you could request the pool, that go to a system, LMS system, lending management system. That system analyze that using the data from the aggregator like Hubble or Finja. They use the data from credit scoring agency, Tasdeeq, and companies like that. Process it, approve or reject the loan, move on. Swift. So that how it should be going. So this is one again. I think commercial banks have safer lending avenues. We all know we need to work on SME lending from being more innovative. I mean, we need to have solution like peer-to-peer lending, private equity, venture capital, and that is to move through the boom and bust cycle. Whenever we have a boom bust cycle in Pakistan, SME lending compromise, and after 2008, it's really hard to recover after that from that perspective. So we need to be more innovative. We need to think and provide the incentives for NBFC, such as I talked about this, the credit guarantee scheme, risk participation arrangement, concessionary funding. They've been done in many other countries. Pakistan needs to do that as well. And once you do that, the development of NBFC specialization would start coming in. And then you could see this peer-to-peer lending, private equity, venture capital, they'll start filling the gaps and all that. And then you can see the vibrancy in that area. Now, this is the thing. We need to mobilize and diversify NBFC liquidity. Now, the cost of fund is a big issue. So that's one of the reasons of failure of the NBFCs in Pakistan. And for that, I mean, they need to have lower the risk. We need to reduce the risk of the NBFC, since they're lending to high risk SMEs. Their own portfolio risk is high, so their portfolio can be partially guaranteed by the government or something. So that could reduce the risk of that, and that could lower the cost of their bonds and commercial paper if they offer, and they can get from the bank at a lower cost as well. Then you need to work on the specially liquidity scheme that to provide that to pump in the liquidity to the NBFCs. Banks are providing to and the commercial state bank is providing to commercial banks. I mean, this open market operation, the reverse open market operation is as high as 3 trillion rupees as of now, but there's nothing for NBFCs. So we need to work on that. Tax advantages. I mean, banks tax has been reduced from 35% to 25% under the National Financial Inclusion Strategy if they are lending to NBFCs. I mean, sorry, if they're lending to SMEs. Now, NBFC's tax is still 29%. They should be reduced to 15% for lending to SMEs, and then other tax intensive incentives needs to be explored. Then the wholesale lending model, as I mentioned about the North Act case, so Pravas can become that. Then informal lending can also be mobilized. So there's a huge space in that, and that wholesale lending model can reduce the cost. Then you need to diversify funding source, again, the development of the capital market, issues of debentures, commercial papers, and other instruments, which is really missing in Pakistan. Then, of course, access to SPP refinance schemes, like the new schemes, SAF is providing refinancing to banks at 1%, while NBFCs is about K plus 1%, 2%, huge gap. Then you need to diversify asset classes by NBFCs. They have to be innovative. They do not have access to payment system and everything, but they need to work on different products to reduce their cost as well. So I think the time is getting over. So this is the last, sorry, just a second. So this is the last slide, and I'll just skim through that. It's about the corporate banking channels. I mean, the partnering with the banks, where they can provide the specialization in terms of understanding of the SMEs, in terms of the clusters and cluster specialization, and using the payment and the infrastructure of bank branches to loan lend. Then they can do a anchor agent program with the OEMs, where they can connect to the Unilever, they can connect to the Indus Motors, and from there to their provider, their suppliers, their vendors can lend to that. Then in the similar way, they can connect to the retailers, and from there, the providers, they can lend to that e-marketplace, P2P platforms. So all those things can be happened. The digital payment operator and aggregator, as I talked about, they should connect to those digital operator and aggregator and get the data from that, use the big data and run through the analytical program and do the score-based lending into that. So as long as leveraging data as the digital space, that is very important, and we need to work on that. So we need to reduce the cost of the NBFCs. We need to provide them the guarantee schemes. We need to provide them regulatory environment, and we need to focus on digitizing the economy to spur on that. And we need to understand that SME lending can really boost through NBFCs, not commercial banks. So that's the message of this report. So we need to strengthen NBFCs, focus toward lending to SMEs using digital means. So that's the message of this report. Here I stop. And if any question, would love to take that. How would I end my screen?
Thank you, Ali. We will not be taking any questions at this point. I would now like to request Ms. Meher Shah to start the panel discussion. Ms. Meher is currently leading Karandaaz Pakistan's knowledge management and communications team. Over to you, Meher.
Assalamu alaikum, everyone. I am unable to start my camera for some reason. So I guess we will just go with my voice at this point. I'd like to quickly, we're running quite behind schedule, and I'm very aware of the fact that some of our panelists have a hard stop at 12. So I'm going to jump straight into introducing our panelists. Our first panelist for today is Mr. Kasif Shahid, who is the CEO and co-founder of Finja, a financial services platform addressing the payments, collection, and credit needs of professionals, merchants, and MSME businesses. Kasif has 25 years of experience working with banks, financial institutions, and has also worked in multiple geographies, including East Africa, Singapore, the UAE, and of course, Pakistan. Our second panelist for today is Mr. Khalid Kabir, who is CEO of Vitas Group, which operates 6 NBFCs that finance small and micro businesses across the Middle East, Egypt, and Romania. During the last 2 years, Khalid has led the process of redefining Vitas's vision and spearheading the ambitious transformation of the organization to a data-centric, digital-first lending model for MSMEs. It's also pertinent to add that Khalid was involved with Kashf Foundation prior to joining Vitas Group, and he was a key member of the transformation team, which transformed the small enterprise lending operations of Kashf Foundation into Kashf Microfinance Bank. So that is Khalid. Our third panelist is Halima Iqbal, who has been extensively in the media recently. She's founder and CEO of Udan. Halima was a former investment banker and consultant with 8 years of experience and has moved back to Pakistan in 2017. She's the only female executive on the Pakistan FinTech Association, and along with her finance background, an interesting piece of information, she is a certified chef. Amar Habib is Chief Risk Officer of Karandaaz, but also of the newly minted Parvaz Financial Services Company. Amar has more than 12 years of experience in the banking, capital markets, and energy sectors. And prior to joining Karandaaz, Amar has worked across a spectrum of financial institutions, including asset management, wholesale risk, and risk analytics. He has worked extensively on sovereign risk assessment and has been involved in the development of credit scoring models for large multinational banks with a global scope. Amar is currently establishing the risk function and framework at Parvaz Financial Services. So welcome to all our panelists for today. I would like to really start our discussion with asking Kasif a couple of questions. It would not be wrong to say that Kasif was one of the first participants in the digital finance space in Pakistan. You've been running Finja, which holds an NBFC license as well as an EMI license. So Kasif, my first question to you is that, given that Finja has made significant headway in the lending space, collections, and analytics, what made it pursue a payments license in the form of an EMI?
Thank you, Meher. I hope I'm audible. Thank you for the opportunity for this phenomenal introduction. Assalamu alaikum, Chairman Saab, Dr. Shamshad, Sir Salim Raza, esteemed panelists, other folks. We have a thesis at Finja, and the thesis is that it's actually the payments that are the real data points to then go out and do clean lending to businesses, MSMEs, SMEs, etc. And these businesses make 3 types of payments. Either they're buying supplies, or they're selling the goods, or they go out and they make payments to operate those businesses, like their bill payments, their rent, their infrastructure payments, etc. And the combination for Finja, we thought, through the EMI and the NBFC will not only allow us to then process these payments holistically, but also allow us, which is very important, to digitize the entire value chain in which we operate. So let me give you an example. So one of the value chains that we focused on are the FMCG value chain, right? And then we have to see that how many actors actually form this value chain. So there are 5 actors that form this value chain. The first ones on the top are input suppliers. These input suppliers, and Ali spoke about it very eloquently, these input suppliers then give inputs to the manufacturers, which are the FMCGs. And then there are the distributors, and distributors, wholesalers, mobilizers, stockists, all of them are the same family, and then the merchants, and then the customers. So what the combination of the NBFC and EMI does is that it allows you to digitize this entire value chain and completely remove cash from it. And the way Finja operates today, we haven't managed to remove cash completely, but there are components of this value chain that we've already digitized. For example, when we go out and onboard a retailer or a merchant or a Karyana store, they have a Finja wallet, and when they go out and make payments to the distributor from Finja Credit, those payments are digitized. So that's where the cash goes out. Now, when the distributors, and Ali spoke about this also, when the distributors go out and make payments to the FMCGs, there the cash is also gone using, the Finja business platform. But because today we don't have an interoperable QR code, which is coming later this year, and now Rast has arrived, the transaction that's happening from the customer to the merchant is still cash, right? And because of that, there is not enough money in the retailer's wallet so that the retailer should be able to make payments to the distributor, whether they are digital lending payments or non-digital lending payments, they should be able to make those payments digitally, right? So what I'm saying is that the minute the QR code comes in, the minute Rast takes root, then the entire value chain is going to be completely digitized, from the customer to the merchant, to the distributor, to the FMCG, to the input suppliers. And then this creates a unique opportunity to go out and infuse digital lending and all of those parts. I mean, when the consumer goes out and buys from the merchant, here's an opportunity to do a buy now, pay later play that the merchant can own. When the merchant, which we are already doing, when the merchant goes out and buys from the distributor, he's already doing buy now, pay later. But even when he had to make payments without lending, that would be digitized. So the thinking behind working with a combination of these licenses is to have this holistic view around payments and about an attempt to digitize entire value chains that the NBFC alone, would struggle to do.
So basically, digitizing payments offers a very, very big opportunity to NBFCs and other financial institutions to be able to offer a more holistic product and service offering, and also, to be able to control the relationship that you have with the client more closely. Is that so, Kashif?
Yes, absolutely, Meher. Look, I mean, we're talking about clean lending to SMEs and MSMEs. And what we are saying is that the real source of scoring these digital loans are actually lying in the 3 different types of payments that the businesses are making. And if you could apply AI and machine learning in the near real time and score these payments, you could bring digital credit to the point where the commerce is happening in the near real time. And till the time you don't do that, you're not creating real value, but more importantly, your unit economics of going out and playing with these loans will not add up, because you know what Finja does. Finja is a capital packaging company that's packaging capital for 7 days, 14 days, 22 days, and this packaging capital is for the conversation we are having is 50,000 rupees or lower. So how do you go out? How do you go out and create digital credit for such small amounts, for such small durations of time in the real near time, and process them in a way where there is no human intervention as you go and open different parts of the digital loan, right? So the digital loan has scoring, it has onboarding, it has disbursement, it has collection, and then it has redisbursement. And till the time you don't take human elements out, you don't take the physicality out of it, you don't bring in all of these things, you won't scale, unit economics won't add. And the only way, the Finja thesis is that the answers of all of these things lie in using payments as a surrogate to go out and do clean lending to SMEs. And both licenses are limited. The EMI license is limited because it doesn't allow you to lend, and the NBFC license in that sense is limited because it would not give you that holistic view. That's a Finja thesis. It's not perhaps the only way this can be done. Meher.
Okay, so Kasif, you mentioned sort of weaknesses in the regulatory in both options that are offered in terms of the regulatory frameworks. What do you think are some of the key, if you were to pick the sort of top 2 or 3 constraints or hurdles that are constraining digitization among lending NBFCs in Pakistan? What to your mind would those be?
Look, I mean, I think, we applied for the EMI license and the NBFC license almost at the same time. We got the NBFC, probably a year before the EMI. And the NBFC allowed us to go and operate the game. The SCCP has held our hand throughout the pandemic. Every time, so I mean, I'm quite happy to report that the work that's happened under the NBFC regime, under the SCCP leadership has been phenomenal, to the point that the regulator is really becoming an enabler. They're a marketplace maker now, and there was an article several weeks ago in a newspaper. It's a research done by SCCP that there are 6 NBFCs that have done a lending of 6.2 billion rupees. Out of which 63% or some was done by Finja 4.2. So the regulator is going out and sort of making heroes out of the NBFCs that are going out and doing digital play. They're going out amending the licenses. We've been awarded a P2P license to do crowdfunding, etc., so that we can create cheaper sources for lending. That was Ali's point. So I think there's plenty that's happened on the SCCP side, but 2 points that I would make. The first one is that a lot of NBFCs, and I say this from experience, not just Pakistan, everywhere, they make a mistake of going out and stepping into the arena thinking that they would start lending in a more rudimentary, non-digital, analog way. And as they go out and build those portfolios, they will digitize their processes, they will digitize their value propositions, and they'll build tech products. And that's where it fails, because once you go out and set a behavior inside of your enterprise of a traditional lender, it becomes super hard to go out and change that behavior on the inside. And then also, when your customers get used to hand-holding and you going out and doing all the work for them, and they operating in the analog world, it becomes very, very hard to change that behavior. So I've seen this happen in Pakistan and elsewhere, where the new organizations, which are new age, get caught up into the old world, and then it becomes so hard. That's point 1. Point 2, very quickly, is that the future we need to understand is about embedded finance and about banking as a service. Now, entities like Finja today should be operating out of many financial institutions' apps as an embedded finance plugin. I mean, if a bank can't do SME lending, there are NBFCs and EMIs that can. So what is it that is stopping the banks to have Finja type companies, lending engines embedded in the front-facing apps for these banks? The problem is that the leadership at the banks do not understand, and I speak directly to the boards of these banks, and their C-level leadership, they don't understand what embedded finance is, what banking as a service is, what platform business modeling is. And they look at these small little NBFCs as their competition, whereas these NBFCs, et cetera, are operating as a very different orbit, and they are enablers for these banks. So the banks are competing with entities 100,000 times smaller than them, and then trying to stop the future from arriving. So that's point one. The second point is that even the new age distributors, some of them are worried about competition, and when they talk about embedded finance, they talk about exclusivity. There can't be any exclusivity when you play in a country as large as Pakistan. So that's what's hindering. But what's come to our rescue, I have to report that, are the distributors and the FMCGs. And Finja is now arriving on multiple apps of conventional distributors and FMCGs as embedded finance. So what I'm trying to say is that, in summary, build your organization ground up as a digital lender and go out and co-opt with banks and the real world players and work hard in having them change their mind. The regulatory regime is already evolved and graduated and is waiting for us at the next stop. I think they are the most underappreciated part of the puzzle, and it's phenomenal what the leadership at both these regulators are saying that. And people who know me know that I would not say that just to score marks, but it's a real gratitude to the way the regulators are thinking as market makers. Thank you, Meher.
Thank you, Kasif. That was very, very detailed and comprehensive. And it also leads me into the questions for my next speaker, who is Khalid. Khalid, Kasif talked about how, it is so difficult changing the DNA of an entity that has really been, it started its life in the analog world, as he put it. So you have been leading the digital transformation of Vitas. Vitas is composed of 6 NBFCs, and you've been leading this for a couple of years now. What were some of the key challenges that you have faced along the way? And also, how has the transformation changed the way Vitas does business?
Thanks, Meher. And I hope I'm audible as well. Yeah, I mean, we are on average in 6 countries, we are 16-year-old organizations. So legacy is something, which we cannot avoid. And legacy is multifold and multifaceted. It is in the people, it is in the governance, it is in the systems, the processes, and the products. So, it is there. And when we 3 years ago, we started to think, and we asked this question to ourselves: how do we stay relevant in this new world where the digital is going to be native, and there are digital first companies, and what will be our role? It was a long journey of soul searching, and a lot of unlearning and relearning had to be done institutionally, educating from our board to our senior managers to middle managers, and which is still going on. So yeah, it was not, the whole soul searching process and defining the strategy was not easy, to say the first thing. I'll come to challenges later. I think there were 3 things which we realized when we were doing this. Number one is that, the end customer is moving towards digital. The new generation, the first instance, the first reaction they have, if they are trying to find a service or a product, they go digital, which means the service providers are also going digital. So whether we like it or not, in a generation's time, or perhaps earlier, we will have to be present there, and we'll have to reposition ourselves. This was first. I think the second thing which we realized was that specialization is the key. Not everyone can do everything. So you have to figure out what you are best at, and you do that. And maybe in this new digital ecosystem, partnerships are the key, because now you can use the technology to exchange and share information in a much more seamless and faster way than what it was before. And I think the third thing, which was, we tried to handle the elephant from the tail also when we started being a legacy organization. I do not feel any shame in saying that we thought that this was a technology problem. And 6 months, we banged our head right, left, and center. And later on, after 6 months, we're like, wow, this is not a digital strategy. This is a business strategy. And digital has to be at the core of it. So we also went through that learning curve. I think there are three questions which are changing the way we work. Question number one was, which we asked, that how have we been acquiring the client? And how will we acquire the client going forward? Will it be the same? If the customer is going digital and the service provider is going digital, and we work with small businesses, these businesses are going to be invisible. So the brick and mortar will not work. So then how do we acquire and find the client? Number one, how do we process the loan? I mean, right now there are 3 touch points. Should we go to 2? 1, it is driven by the regulation. It is driven by the infrastructure in any given country. But the processing will have to change. Data, AI will all come in the meanwhile. But the reality is sometimes either the infrastructure is not there, the client is not ready, but we will have to get ready for that wave when it comes. And the third question was, I mean, in today's world, a customer or consumer likes to stay connected all the time. For example, the customer behavior is changing very fast. They want to be connected. They want their service provider to be intuitive. They want customized solution to all their needs, on their fingertips. So the whole, one of our core values, which at VITAS we have, is the connection. So how do we stay connected? And that will change. I'll give you one example how it is changing. We are running a pilot, and I think I agree with my fellow panelist, Kasif. Embedded finance is the way to go. And we have done this pilot in Lebanon recently, and we are going to Iraq, whereby there is a delivery as a service platform, and we are offering 3 kinds of products on their platform to their customers. So we are becoming a lenders as a service. This is what we are saying. It was not easy because the tech companies, they work at a different pace. I mean, this is one of the challenges we have. And we are a legacy organization. So, there is no match in terms of pace. And I'm not surprised to see in Pakistan how the tech companies are going towards the NBFC licenses. I understand, it's not easy to match the pace. So embedded finance is one of the, for example, things which we are trying to do in our organization. The way we have isolated it, we are not going to disturb the legacy infrastructure. So what we are saying is, this is a new channel, this is a new segment. We are not trying to convert our existing clients to digital. I mean, they will come when the wave comes, but right now we have to position ourselves to be ready when the wave comes to go into this. So it's a new channel, it's a new way of doing business. Internally, we have segregated it and isolated it from the existing business. I think one of the challenges, I think the most major challenges is the people. Anything which I say is an understatement. The time it takes to educate the multiple layers of our team members, starting from the board to the senior managers. But the interesting point is, the easiest to change are the frontline officers, because they are the new generation. The hardest to change are the more senior, at the governance level. No disrespect. So I think this is the most major challenge. One thing which I would like to say is that, being a Pakistani, I follow Pakistani regulation and the market very closely. And I think Pakistan has a dreamlike infrastructure and regulatory framework. Really, our average ticket is $5,000. So we're really into small space. We don't go micro, we don't go too big. And, it troubles me to see that why there are no, I have my own views, but I think the regulation is absolutely dreamlike. The infrastructure is there.
So Khalid, what you're mentioning about legacy really kind of reminds us of, what's been done by the State Bank with regards to the new digital banking license that's been offered. Initially digital was introduced into existing commercial banks and, under the branchless banking regulation. But legacy and governance and all those issues, I think, were one of the reasons which really kind of prompted the State Bank to carve this out into a separate entity. So legacy is very real. Like you say, it's multifaceted, and it's also multi-layered because it runs through the different layers of the organization. So thank you. At this stage, I'm going to move to Halima. Now, Halima, also touching on one of the topics for our panel discussions on financing. we're all aware that Uran recently raised about $3 million in funding from local and international investment firms. So what were some of the key challenges faced in that process? I ask because, financing is considered to be a key constraint for the NBFC sector. And while other sources are also there, I think this the source that you have tapped, it will be interesting for our NBFCs to know more about it.
Absolutely. Thanks for having me here. A pleasure being sharing this platform with my fellow panelists as well. In terms of the financing, we raised equity financing. So it being a tech startup, you need equity to run the financing or day-to-day operations. And as you build the company, you obviously need more and more capital to be able to grow and to build the kind of products that you would want to build. From a financing perspective, the challenges are, I think it's from an ecosystem perspective, it's clear, right? Like last year was the first time we saw the kind of investments coming into the ecosystem. We have been in operations since 2019, and that year to be able to raise the pre-seed was completely different than what we saw last year. But also access to capital as a female founder globally is limited, let alone talking about Pakistan, right? So the challenges around that, the biases, the gender inequality when it comes to VC dollar going into female founded companies, but also solving for female centric problems, which is what Uran does around providing access to capital to underserved millions, especially women, and designing around their behavior, designing around their requirements. So to be able to sell that, because it is hyper-segmentation in financial services is a conversation that started a year and a half ago, and we've been at the forefront of it, that financial services and financial products needs to be designed around special use cases to be able to change that behavior and have that impact that you would want from a financial inclusion perspective, especially in Pakistan, where the gender gap is so large.
Okay, and my second question for you, Halima, is on, Uran is a for-profit fintech and is also currently part of the SECP's regulatory sandbox. The company has applied for an NBFC license. Can you share some of the reasons for pursuing this option relative to, say, an EMI license?
Absolutely. From our perspective, the idea was, how do you provide access to capital before you talk about digitizing payments? And the audience that we cater to, they might have some form and shape of access to bank accounts, but those are dormant bank accounts or dormant wallets. The problem that exists is, how do you provide them with access to capital that is fast, that's efficient, creates a financial identity for them before you go on to solve for their payments problem? And that's really the reason why we went down the route of an NBFC, and really think around like building and designing experiences that gives that financial mobility to a woman and her household, and changes the behavior from using cash to then digital payments. And when we talk to the customer and we understand and we build around her, one of the things that we recognized was that payments is not something that digital payments is not something that she would be completely against. It's just that she doesn't have access to that capital to be able to do that digital payment. So there is obviously literacy that's required, but the bigger problem that we want to be able to solve for is give her the access and then change that behavior by hand-holding her to digital payments. And that was the reason for us to go for the NBFC rather than EMI.
Okay, that's interesting and also very heartening to see that, you know, Udan really is building itself around the financial needs of a female clientele. We know that there's a very big gap there, so excited about your work. Amar, that brings me to you on, you know, the question on financing. Very often when one speaks to participants in the NBFC space, there's a lot of, there's significant mention of the fact that financing is a challenge. So in your opinion, how can NBFC sector financing be diversified beyond short-term lines from banks?
Thank you, Meher. I think this is one of the more critical issues for NBFCs. If they need to ensure sustenance, which obviously they do, and to avoid an asset liability mismatch, they need to diversify away from traditional bank financing. Now, traditional financing normally, as you said, involves getting limits from a bank with a tenor of around 1 year or slightly more, while asset maturity for NBFCs is most likely much higher because SME finance requirements, as we have seen in our research reports and everything else, are more oriented towards fixed assets investments, which have a longer maturity profile. So what's happening is the asset maturity is higher than the liability maturity, and this leads to a perpetual asset liability mismatch for the NBFC, which was exacerbated during stress circumstances, which can get exacerbated in stress circumstances, as we saw in 2008. Following which we saw a number of NBFCs closing or just getting dormant, and from that we haven't really recovered. So the sector needs some kind of a catalyst, and that catalyst, as Ali had also mentioned earlier, can be the SAF scheme of SBP, which, if it enables wholesale funding for NBFIs, can provide that injection of core capital, which can then further be used for lending to SMEs. It is definitely important to diversify capital sources, and that would also include tapping into capital markets as well as retail investors directly. I would appreciate Finja here, which has been targeting retail investors and carving out a niche so that it can get some kind of sticky capital, largely mimicking retail deposit, but definitely at a much higher rate. Still, that's a step in the right direction. Then there's a lot of risk capital which is floating around looking for a place to get parked, and just the ability to easily access debt market, whether that's through commercial papers or through long dated bonds, can play a critical role in not only developing a capital market, but also provide a stable base for NBFCs. So what's happening now is it's really difficult for anyone to just go out and buy a bond. You can go and buy stocks. Even for that, we have barely like 150,000 to 200,000 investors. You can easily buy equity, but to buy bonds, it's just next to impossible unless you're an institutional investor. So from the supply side, that needs to change, because there are people with funds in banks who are looking for a higher yield. In absence of other options, they either go for a term deposit with a bank, or they can simply go to national savings scheme. So this is a large chunk which needs to be tapped, and that can be done through, I would say, making it much easier to participate in the fixed income market. Another source of capital would be mutual funds, who have seen their fixed income assets under management grow tremendously over the last, I would say, 5 years, well, largely due to an increase in money supply and so on. But they can also be good suppliers of NBFCs, as long as the capital raising products which NBFCs use are structured in a manner which aligns basically with the needs and requirements of mutual funds, which is different from other kinds of investors. Another source of capital which plays very safe and whose regulations are also more on the conservative side are pension funds. Making it easier for them to invest in bonds and commercial paper can also unlock a large chunk of capital which can be tapped by NBFCs. There's often this thing, there isn't enough capital available outside non-bank. Outside the banking system, there is sufficient supply of non-bank capital, but that needs to be directed in a way which it can come towards NBFCs. By tapping through some of that capital, it will be possible to provide a stable, I would say, capital base for NBFCs, which which can also provide, I would say, better yields for investors and mutual funds or any other alike, especially as compared to a bank. So I think this sums it up for me.
Thank you. Very, very comprehensive, Amar. Kasif and Khalid, if I were to sort of ask you all to react to Amar's list of sources that can be accessed, do you have anything additional to add, Khalid, let's say from the Middle East perspective? If I come to you first.
No, I mean, I think the list is comprehensive and pretty forward-looking, I would say. I mean, the way we work is that we work with mostly with local commercial banks, and we have lines with them, so we borrow wholesale from the commercial banks and on lend. I think the question is, why, for example, the banks in Pakistan haven't been keen on doing wholesale lending for SMEs. And I think the question is not the supply. I think the question is really on the operator side. The onus is on the players. I mean, so far, Parvaz perhaps is the first specialized, really the SME or VSC and S perhaps, or M, one part of it, company in the country. Otherwise, it was SME bank. So no one has really shown a business model which works. Once you show the business model, I mean, the funding comes through in one way or the other. But going forward, what we are looking at is that, how do we use technology? And, there are crowdfunding platforms. There are other ways to raise funds as well. We haven't cracked that because we did not feel the shortage of funds, so far, at least in Middle East, North Africa.
Okay, and thank you, Khalid. Kasif, is there something you'd like to add here?
Yes, I'd briefly like to speak about two things. One, we've enjoyed a partnership with multiple players in what we call the off-balance sheet lending configuration. And, a very deep partnership that we enjoy today is with HBL. And, the State Bank, and, this is an example of how regulators are going out and market making in this country, that the State Bank has allowed HPL and Finja to go out and operate in a off-balance sheet configuration where all the work is being done by the fintech, meaning sourcing, scoring, onboarding, disbursement, collections, and all of that. And once those loans mature, we have the ability now to lift those cohorts and put them on the bank's balance sheet. And the bank would release capital to us and we share the revenue with the bank. And this is the leadership at the State Bank and senior leadership at the C level and the board at HBL that is going out and leading by example by creating these configurations and solving the capital problem that a fintech like Finja would eventually run into. Now, today, this is a tunnel approval between Finja and HBL, but tomorrow, looking at the scale and success that would be made, this is going to be made open to multiple fintechs and multiple banks. And this perhaps would be one way to solve this hard problem. The second thing that I wanted to speak about, again, is a phenomenal example of the regulators' foresight to come to rescue of a NBFC, and these are the pandemic times, and it's not Finja, but it's actually the SCCP that suggested, and we are operating under this configuration that suggested a P2P crowdfunding play, where today Finja can go out and solicit deposit from businesses and individuals and park them directly into our lending, Karyana lending portfolios, and promise a return of as high as 20% annualized or 1.67% monthly. And now this becomes another alternate source of capital, which today is operating under Finja is the only one which operated the sandbox and now has a commercial approval for it, but within a certain amount of limits, but tomorrow multiple other players will be able to create P2P lending platforms with multiple use cases. So here is another example where the regulator could foresee that in the pandemic world, the banks are going to sit on the sidelines and the VCs are going to sit on the sidelines. And what is it that the NBFCs would do? And it was an example of a proactive regulatory sandbox regime that the regulator came up with. And we are enjoying both of these. We are enjoying today the off-balance sheet configuration and also the ability to solicit deposit directly, investment directly from businesses and individuals, and promise a higher return that the bank can. Thank you.
It's very exciting. So the P2P platform is functional. Could you give us a sense of the quantum that you're able to, if that's not too intrusive a question?
These are early days, so we've got close to 100 million rupees that we've processed through this as investments, and and there are several hundred merchants that have actually gotten these working capital loans coming directly from the businesses. We have a certain amount of limit to how many new users we can bring in on a monthly basis, both business and individuals, and these limits we are told are going to move away incrementally. So in the next 3 to 6 months, we would probably operate without limits or much higher limits.
Okay, thank you. So I'm afraid we are running out of time. I do not see very many questions right now in the chat box. So I think I would like to just request each panelist if there are any kind of closing words that you would like to say before we close out this session. Or even a question to each other, if you all have piqued each other's interest.
I think I would like to mention, Qasif, especially, we ran the service company model for 15 years in Lebanon. Before the crisis in Lebanon, we had a portfolio of around $38 million, 80% of which was booked on the bank's balance sheet. But then 5 years ago, we started to roll back because the real question was, it was affecting the customer centricity and we wanted to be closer to customer. So we rolled it back. And now we are looking at it again because 5 years ago, the tech ecosystem was very different from what it is today. And it's all about process and the information sharing. So perhaps we are going back. So we have gone the full circle. So it's very interesting to hear that you are experimenting with HBL on this.
So I think some of our panelists will be dropping off now. And with that, I will thank the panelists. I think this session was very informative, very useful. And we will close off here. So handing back over to Shabano.
Thank you, Meher, and to all our panelists for this very thought-provoking discussion. I would now like to welcome Mr. Salim Raza to share his concluding remarks with us. Mr. Raza has over 40 years of experience in the banking and financial sector. He has held the position of the 15th Governor of the State Bank of Pakistan, after having worked in the international banking industry for over 36 years. His business experience covers credit and corporate finance, real estate, and global asset management. He currently serves on the boards of Habib Bank Limited, International Industries, and Planet N Group. Please welcome Mr. Raza.
Thank you very much. I will try and keep this short. As someone noted, the world has run far ahead of where we think it is, and it's very encouraging to see in Pakistan, hearing from Qasif, Shahid, and from Khalid Kabir, and from Ali Khizr, of the incredible progress that and the initiative, the perspectives that are coming into play here. I had a written script that I was going to read out. Let me discard that and just make a few observations about about the things that we may not have brought up, or just my insights into what may be small missing pieces or small missing opportunities in the context of what we've been talking about, which has largely been the role of digital in serving the market for smaller players, which I agree with. The conventional way has been slow, and now after what, for 20 years of microfinance, if we only have how much is it? 230 billion rupees or 400 billion rupees in microfinance loans outstanding. That's not really great progress. And 7 million customers against 22, 23 million in, 26 million, 27 million in Bangladesh. Therefore, digital. And now in Pakistan, let me tell you why I think we all know, but let me just put this a little sort of into numbers. We have one of the smallest banking systems in any emerging market of any size. 30% of GDP, that's the size of our deposits. Our neighbors to the east are over 50%. And any developed country is over 100%. So and then on top of that, developed countries have very deep bond markets that in some cases can be as big as the banking market. And we don't really have a private bond market. We have a big government bond market, but not a private. So small banking sector. The government takes up 52% of banks' loanable assets in government securities. Another 15% is lent against government guaranteed entities, such as the IPPs and other government state-owned vehicles. So that leaves about 33% for the banks to lend to the private sector. And of that 33%, about a sixth, 5 or 6% of the whole of the 100 is what is lent between SME, agriculture, and consumer. Now, it's not really very meaningful to try and seek, if the banks have opportunities to lend to the top end of the corporate sector, they're not going to lead a charge into the SMEs, leave alone into microfinance, which is what the segments you're seeking to serve would be. So we have to look for another route. Now, the other route is clearly, we have the highest cash in circulation of virtually any country in the world today, 42% of deposits. You will have to search hard for a country that has more than 20%. So we've got a colossal amount of cash. It's about, against deposits of 19 trillion, we've got cash in circulation of 6.8 trillion. And that's the market that when you talk about supply chains, for example, the supply chains that was mentioned was, FMCG, distributor, sub-distributor, then from the sub-distributor to big retailers, department stores, small retailer, and then credit sometimes from the retailer down to the market, down to the buyer. And that's where a lot of cash is locked up. A lot of cash is equally, which wasn't mentioned, but to me, that would be a crusade. A lot of cash is locked up equally in agriculture. And the farmer ends up, because the farmer is using someone else's cash and buying his inputs through someone else and selling his goods through someone else and leasing his agricultural machinery through someone else, he's paying margins to people whose business is not agriculture. So in the end, he ends up with sort of 60% or 50% of what he ought to have gotten if he was self-financing. So again, digitization, as I see it, directly to the input supplier, directly to try and find out the end market, try and find what the price is when you're selling to the RT or you're selling to the mandi. Anyway, these are huge opportunities. I'm very pleased to hear that the regulators are also running ahead of where our institutions are today. So RAS is a very good example. SSCP's willingness to let new types of financial intermediation companies come up, very, very encouraging. QR codes, I agree, once QR codes are there, and when I can, which I shouldn't be doing, when I can buy a packet of cigarettes by simply tapping my QR code on the retailer's phone, that's the day this cash will start to come into the banking system. And Ali Rizat gave a figure of 800 to 1.5 billion. So I mentioned, 7.7 trillion as being the cash in circulation. If half of that came into the banking system, or let's say 1/3, if 2 trillion came into the banking system, then through the banking multiplier, that would turn into 7 trillion of loans, which would turn into 7 trillions of deposits. And then you take the second bank would lend that 7 trillion, and then the multiplier would operate a massive expansion in our system. Now, against the numbers I've mentioned to you, our total credit, private sector credit in the system is only about 8 trillion rupees. So unlocking this cash, I think, would be the greatest development contribution that your initiatives could make. If I can just mention, you mentioned a number of ways in which you're seeking to finance, partnering with banks, partnering with others, partnering with fintechs, trying to arrange some refinance, participating in the state bank's refinance and low-cost finance one way or the other. They're all very good. Someone also mentioned trying to get crowdfunding. What India has done, I think most of you know, and I know the State Bank was looking at this. India has allowed two entities to list on the exchange there who quote bundles of receivables. This is a very old business. It's called factoring. It was the oldest. It existed before banks existed. In England, for example, factoring companies have always existed. They take small credit into market that they've had experience with, bundle it together so that there's an actuarial distribution, and then sell it to investors at a higher rate than they'd get from conventional bank instruments. India now has, the first initiative was led by the Reserve Bank of India, their central bank. And then partnering with others, they placed a company that was bidding, that was offering receivables for sale for 6 months, 9 months, 1 year. And this was receivables picked up by thousands of companies operating inside the Indian market, rather like the Hubble, Finja, others who are or let's say intermediating different types of supply chains, picking out people who participate in those supply chains, at some stage in the process, picking them out, creating a payment record for them, which allows them then to be rated. And then these receivables, then you can provide them liquidity by listing their receivables on this exchange. And that people who buy from the exchange can be anybody at all. There'll be a rating and there'll be a price quoted. And investors can pick what they want to do and whatever they want, whatever period, what they want to buy, whatever rate interests them. So that, I know the State Bank here was looking at that. That is something that should be taken forward, because what your experience and what your AI is going to sort of show you over time is that a lot of these people who owe 30,000 and 20,000 and 15,000, a lot of them have solid track records. Could be rated absolutely top of the world. If you've got 500 of them, bundle them together, place them on the market. And so that is one avenue among the others that you mentioned. I mean, there's co-lending with banks, so getting banks to partner with you, I think, which Fasil mentioned. That's a very good idea to the extent that banks can be persuaded. But I've shown you already that banks are really squeezed. And the government's squeezing very hard now, because government borrowing requirements are very significant. You're going to see more and more. You're probably going to see more treasury bills and PIBs being placed with banks, and this 52% would become even higher. So going to the cash market, so going to the investor market directly, is a route that should not be ignored in some of the ways I described. And certainly partnership with banks is good, but I wouldn't hold my breath on how much there is that you can gain from there. I mentioned agriculture. I think that is really ripe for this whole digital process that you've talked about. I won't go into detail. We have warehousing company. We have a company approved by the SSCP that now licenses warehouses. Now, once you get cold chains and warehouses, once they become interesting enough for significant private sector investment, and I won't go into ways in which how that can happen, but it is beginning to happen. Then the farmer can lodge his stuff, whatever it is. Today, he has to sell the moment the crop's ready, because he's got to get ready for the next season. But tomorrow he can get a warehouse, he can lodge his crop with the warehouse or the cold chain. He can get a warehouse receipt. He can finance that with the bank, get ready for his next crop. And his crop will now be quoted on the National Commodity Exchange as this quantity of X at a price of X. So suddenly his market access goes well beyond his own locale, and he gets a Pakistan-wide audience. If you want to take it to a sort of absolute lunatic level, what might be possible? Well, it could go to an international audience. That's what happens with coffee stocks and cocoa stocks in Africa, where they lodge the international buyers see a price and see a quantity and see a quality quoted. So we're not going to get there yet. Let's just get the first stage, which is warehouses and warehouse financing. And then you have, you can see the farmer, which I think is the biggest upside in Pakistan, by the way. The biggest upside is giving agriculture back the margin they deserve, which today is taken out by non-agricultural intermediaries, by RTs, by transporters, by market operators. If you give it back to them, that's our biggest upside. Somebody talked about, so we're talking about, I think Amir talked about different types of funds. You see, the solution to government borrowing from banks is development of mutual funds. Now, somebody placing money with UBL or MCB or Habib Bank today on a savings account might get 9% today, but the 3 months treasury bill is 12.5% or 13%. In fact, I think yesterday's bidding was over 13% for the 6 month. So the government is borrowing at a premium to what banks pay for the same tenor. This doesn't happen anywhere in the world, and the reason, because the rate the government quotes is the benchmark. It's the lowest rate in the market. All other rates for similar maturities are above that, because government is a riskless asset, and banks don't have to reserve or put any capital up against any government paper they hold. But because the government is restricted to borrowing from banks, then it cannot. It's a rate taker. The way to change that is to have the government distribute to the broad market. And why shouldn't people who are depositors today become investors in a mutual fund which is immediately liquid, that invests primarily in government securities? What will happen then is the government security rates will have to come down because there's much bigger distribution, and the rate the banks pay will have to go up. But then where do you place these? Who buys these mutual funds? Certainly, big investors can buy them, people who've got big deposits in banks. But why not miniaturize your treasury? Why not give? Why shouldn't someone be able to buy? Someone with 3,000 rupees, why shouldn't he be able to have a piece of that treasury? And therefore, our mass market really can be, which is today perhaps not in the banking system, a lot of it. Perhaps they can, for their saving, look at investing in these mutual funds that can miniaturize paper that otherwise, where the minimum that you can buy is 50,000 worth or a lakh's worth. So I think that's an area also that this whole digital initiative will enable. Lastly, the IMF has made has commented that we have ended up with a multi-interest rate market, because depending on the business you're in, the state bank can offer you different refinance rates. You can get degrees of credit support through first loss guarantees for certain different amounts. So we're ending up with effectively multiple interest rates. And they have, this time, I think one of the performance indicators they've asked us to write a paper on, and then later that can turn into something we'll have to implement, is taking refinance out of the central bank and putting it into a government finance vehicle, so that all the subsidy that is coming from the state bank, i.e. coming from government, now shows up in a DFI that is financed by government. And the reason is that such subsidies should be part of the government budget. If you leave them in the state bank accounts, they sort of disappear. They sort of they're fungible with the rest of the state bank's accounts. And now, if that happens, then this access to different types of refinance, it won't go away. It will certainly be there, but it'll have to be prioritized, and it will probably be over time. It will be more limited than it is today. So everything I heard about, that depended on being part of facilities where refinance or first loss is guaranteed. Hopefully, some of this will continue in the future, but it's not. In my mind, it doesn't look like a long-term, like a way, something you can depend on for the long term. Anyway, sorry, those are just some. I had a written speech here, but like I said, here, listening to people here, I thought I'd and seeing where the market is at the speed you people are going at. I just thought I'd make some comments that sort of address little pieces that had not been discussed, just in context. Those are my comments. Anyway, it was stimulating to hear everybody. Delighted to have been part of this. So thank you, Meher.
Thank you, Mr. Salim, for sharing your valuable insights with us. On that note, we will be closing the webinar now. The full report is available on Karandaaz's website in the publications section. The recording of today's webinar will also be uploaded on our social media accounts. I'd like to thank you all for joining us today. Have a good day.